Thanks for joining us today on The Close. I'm Morello Fernandez. Markets close in 30 minutes. Let's get to the stories we're following out of the BNN Bloomberg newsroom. G7 finance ministers saying today they will take any steps needed to support global energy supply, including releasing strategic oil reserves, but just not yet. The Middle East war driving crude prices sharply higher. A release from global stockpiles could help to ease supply disruptions that have pushed Brent crude close to $120 a barrel. Saudi Arabia has started reducing oil production because storage tanks are filling up. The cuts by the world's biggest oil exporter follow the United Arab Emirates, Kuwait, and Iraq. Some of the countries have been turning production lower so as not to overwhelm storage too quickly and avoid a complete shutdown of output. We are watching shares of Constellation Software. Shares are down. The company reported quarterly earnings that missed estimates and did show a sharp decline in profit. One of its companies reported a large non-cash expense tied to the rising value of an investment. The Canadian software company also reported quarterly sales of over $3 billion. That did beat the estimates. The beat was driven in part by acquisitions and continued growth across its various software businesses. A bit of a comeback today for the TSX. It's up 64 points after starting the day down in the red. It's still above 33,000 at this point. South of the border, the S&P 500 moving up 0.6% today. The Dow Jones 175-point move up, 4.4%. The Nasdaq also up 258 points or over 1%. And oil still surging, but falling back below the $100 barrel mark, while stocks are mixed and there is some choppy trading. For more on this and investment ideas, let's go to Garnet Anderson, Head of Portfolio Management at Tacita Capital. Thanks for coming in.
Thank you for having me.
Okay, let's talk about oil, which we've seen really move up on the weekend, still up today, not as much. Are you invested in oil? What are you doing with your oil investments right now?
Well, first of all, pretty well any Canadian probably already is invested in. It's about 17% of the TSX composite benchmark. So you already have that. In terms of going into futures or what have you, or specific futures exposures, no. We have it through some of our models in terms of energy start to percolate up into the momentum sleeve, going back a month to 2 months ago, which we start to add in at that point as we start to shade away a little bit from the gold trade.
Okay, I was going to say gold is off, and we think of it as a safe place to go in times of conflict. So what's going on there?
Well, gold, so what happens when you have interest rates that have crept up, call that 20 basis points for mid-belly Canadian and U.S., that means the cost of carrying gold is that much lower because it doesn't pay you any interest or any dividends. Then there was a little bit of strength in the U.S. dollar. So that also steals some of the attention away from gold. And the other thing, too, it had been rolling ahead largely on central bank buying, on ETF buying, on jewelry usage. Central banks still are putting their pennies to work there and still accumulating. Naturally, the ETF flows are a little bit in and out. So it's not surprising they came for a breather, but there's a little bit of a boomerang effect. We're more a believer in bullion, necessarily as opposed to gold stocks. Plays a little bit of a longer-term hedge position against inflation. Short-term, it doesn't do much of anything. And what we saw was basically the gold price moved up in 23, 24, and then pulled gold stocks higher. And so we see gold up 75% last year, but gold stocks up 125%. And kind of makes sense because you go, oh, prices up, prices up, prices up. That means more cash is falling to the bottom line. Well, a little bit of reversal, but we're still up on the year. So I don't think it's time for anybody to panic. But it maybe is a little bit of a call to action in terms of those folks that have gotten a little loose and fancy free in terms of their allocations. Check their shoulder. It might be a time for rebalance. It's hard to sell into a rising market or a rising theme all the time. But if you can get some of your costs back out, it gives you a little bit more patience to ride it out.
What is your take, or how are you advising investors? We saw the big drops last week, TSX taking the hit. It's climbed back a little bit today, so it might end the day up. But are investors, you find, panicking? Are they selling in a panicked way?
No. If the TSX this morning was off 6% drawdown basis, you can start to say for more aggressive investors at the minus 5%, you might perk up your ears. You might look for certain opportunities. I mean, there's opportunities out there for the believers. I mean, you spoke about Constellation. or you got your other software providers, OpenText and what have you. And you certainly have in terms of the asset managers on both sides of the border, like the alternative asset managers such as BAM. So there's opportunities out there. But would not call it -5 or -6% a chance for the average investor to say, oh, this is buy the dip, I've got to push all my cash in. We came into all this revving higher on our cash allocations. And so for the more aggressive, we might be taking a look at nibbling. But for our average client, we're saying, look, that was there for buying protection. So that if we got a marked setback for all the other things going on in the world, Kuzma, U.S., the U.S. tariffs, the geopolitical, it goes on and on and on as long as your arm is. We want to keep some buffer there.
Okay. You like Suncor right now, and I know it was up like 60% last year. So would you still buy in? How long have you been holding?
We've been holding that now for, I'm going to say that one for about 4 or 5 months now.
Okay.
And so it is very good from an operation perspective. It's mostly sold to the Canadian marketplace. It's integrated. It goes from, extraction to upgraders to refineries to your local Petrocan.
Okay.
Some exports to the States, minimal international. It's got a good balance sheet. The thing that analysts like it, but it's close to its 12-month target. But what could change there? First of all, last year, the period ending in February, early March, it bought back like 54 million shares, 4% of its float.
Okay.
It just announced that it could buy back up to 10% of its float.
Okay.
That is a big buyback. Now, whether it gets to 10%, I don't know. But for every dollar, per their investor release presentation, for every dollar that West Texas goes up, it's another $200 million of profits. So if you've got $3.3 billion worth of shares to buy back, that certainly helps. That decreases your denominator, increases your earnings per share. So we think it's both good operationally, it's got good momentum, and we like to see that share buyback and discipline with the cash.
So you'd put new money in today?
Oh, that's an awesome question. We would probably, I guess we are comfortable with our current position. I think somebody who doesn't have, again, I think that'd be the remote investor in Canada who doesn't have energy exposure. I think it's a good candidate to go and put your anchor in. But these kind of trades in the midst of a panic such as this, don't put your full allocation. Edge in.
Okay. Let's talk about Chartwell REIT because you like this one as well. How long have you been in that space? Well,
that one we started to build back in 2020. Came out of COVID. And their vacancies, my recollection was down in the mid 80%. They naturally had all the cost of COVID, the extra nursing, the extra care, the plexiglass, you name it.
All the equipment, yes.
And so we said, well, this is a recovery play. We know demographics. That's the easy part of the thesis.
Yep.
And they have executed very well. And so they've seen, like for example, you take the last year, their earnings per, or the revenue per same suite sort of thing was up 8-9%. And their earnings was up, 14%, 17%, somewhere around that area. So what's that showing is they've got operating leverage, which is nice. The other thing too is their share price has come so far back. I mean, we want to go from COVID, it's quadrupled. Now, mind you, it took about a 40% step back in 2022. When inflation interest rates take off, few are left unchallenged. And it's tripled since then. What does that do? It gives it a currency. They can now go out and acquire new residents. They can now afford to go out and build new capacity. So that should stoke future growth. And growth in the REIT market isn't always a given. They seem to have right now the good chemicals right there to be able to push that agenda forward. Brings different risks, development risk, acquisition risk, but we're comfortable with that. But again, because it has been so well, and there's other healthcare REITs as well, it would be one that would be a cornerstone of the portfolio, but it's not something that you would want to over-allocate to.
So like percentage-wise, where would you be with that?
Well, I would say that depends on how you slice and dice it. We would look at it as part of an over pool that's got 60-odd holdings. Okay. And in there, it's called 2.5-3% weight in there. Okay. Because again, it has done well, and the growth is there. Where in other areas like residential, office, retail's had okay growth, but you're always worried about the consumer, the non-defensive retail rates. So the other areas in the REIT market haven't had the growth. The other areas in the real assets, kind of, we talk about energy. Yes. What about Enbridge? What about TransCanada? Great stocks. Yeah. Nice yield. But they are priced as such. So they're hard to put a lot of new capital toward.
Okay, got to leave it there. Garnet, thanks for coming in.
Thank you very much.
Garnet Anderson is head of portfolio management, Tacita Capital. Up next, oil, as we mentioned, above $100, close to 120 on the weekend before paring the gains back today after the U.S. president said the war with Iran could be reaching its end. More in a moment. All right, we're going to have a look at what oil is doing right now. It had pushed past $118, closing in on $120 on the weekend, U.S., of course, a barrel, and remained elevated today in the sort of $96, $97 range. But moments ago, the U.S. president said that the war with Iran could soon be over. He was speaking apparently in a phone interview with CBS. Let's start there with Reid Ianton, economist at Kepler. He joins us now. Everything with Donald Trump is very whipsaw, as we've come to know. What's your take on how quickly we could see a reflection in oil? And again, he has said before, rolled out a timeline of a month or more. So this answer changes. Will this be a material move, you think? We haven't really seen it yet.
Yeah, I mean, it's, quite impressive to watch the shifts in oil price just moment to moment, even today. That upper wick on WTI touching 120 per barrel and now looking to test below 90. But I think it is important to keep in mind that for now, given the effective closure of the Strait of Hormuz, that's 10% of global supply that's not getting to market, right? Pre-war, you were looking at 13 million barrels per day of oil and another 2.5 to 3 million barrels per day of transportation fuels flowing through there. That is a considerable amount of supply loss. And so I think all eyes are going to be on, does the Strait get reopened? It's interesting kind of seeing the Trump comments kind of realizing, a need to kind of get that Strait reopened. And so we'll see if the U.S. military can make progress on that front.
Yeah, apparently he is now, the U.S. president, mulling over taking over the Strait of Hormuz, which to me sounds like a whole different conflict if America tries to do that. Factor in Saudi Arabia for me, because there are reports Saudi Arabia is going to be cutting production as a result of running out of room to put their oil. Do you think that weighed heavily on any decision or comment by the American president?
I think, of course, the GCC partners with the United States are obviously playing a role in how the Trump administration is thinking about this war. It is important to keep in mind, though, states like Iraq and the UAE are a bit more constrained than Saudi. Saudi does have a 7 million barrel per day east to west pipeline that allows them to export somewhere between 4 to 5 million barrels per day out of the Yanbu port in the Red Sea. So Saudi has a little bit more optionality to work around the Strait of Hormuz issues than some of the other players bordering the Mideast Gulf at this time.
So the capacity for Saudi Arabia's pipeline, then they could up it if they want to. Is that a possibility?
They're already doing that. The East-West pipeline was already doing something somewhere around 2.5 million barrels per day of flow pre-war. We've seen that double over the last week, and so I think it is realistic to think that Saudi can push somewhere between 2 to 2.5 million barrels per day of additional crude via that East-West pipeline. That does provide them some optionality here.
Reid, talk to me about China and India and how heavily they are affected by the Strait being pretty much shut down to transportation of energy as compared to North America.
Yeah, Asia is highly reliant on Mideast crude. However, the coverage due to domestic stock levels varies a lot across the major import economies in Asia. Places like China and Japan are pretty well set up to handle an extended outage, say 4 months of import coverage. South Korea kind of sits in the middle range there, say maybe 3 months of coverage. But India is very exposed, about a month of domestic demand coverage at this point. So again, I think that's why you're seeing the Trump administration as well kind of allow the Indians to start importing more Russian crude and easing those sanctions a bit, because there is an understanding that India in particular does not have a lot of domestic inventory availability, and they need to be importing crude from abroad. Keep in mind that pre-war, 80% of Indian crude supply was flowing from the Middle East.
Okay, Reid, I got to leave it there. I'm out of time with you, sir, but thank you for your time. Reid Ianton is an economist at Kepler. Coming up, we've been watching a massive payday for one of the mining world's most influential families. That is straight ahead. Stay tuned. After putting $17.5 million into Montage Gold back in 2024, the Lundin family has now seen that stake explode in value, delivering a staggering over 2,000% return. We were joined by Bloomberg Canadian wealth reporter Ari Alstetter on this.
They already owned a large stake of Montage Gold when they, in 2024, when it started building out its sort of flagship asset, this gold mine in Ivory Coast. It needed more money to actually get that project off the ground, so the Lundins provided it. Ever since then, as they've been building out this mine, I mean, it's made progress, and in January it announced that ahead of schedule is actually going to begin gold production at the end of this year, which of course is coming at a time when the entire market is just crazy for gold. Gold has reached historic highs in terms of price per ounce as the financial system seems to be changing under our feet. And that has been reflected in Montage's share price. Suddenly saying we'll be able to get more of this stuff out of the ground by the end of the year has seen those shares surge this year, and that's meant that the very low price that the Lundins paid for their shares when they were investing money to get the mine built has produced a huge return. They bought those shares at 70 cents a share. They're now trading about $15 a share. So you can do the math yourself. It's pretty big.
And as recently as January, Montage was drawing up estimates for the gold it had in Ivory Coast based on just $3,000 an ounce over 16 years. And of course, gold may well slump again.
That's true. They put conservative estimates for how much that gold is worth, but the basis for those estimates was $3,000 an ounce. So over the long term, of course, right now, gold's trading at $5,000 an ounce. So a big change there, and really the key to that shift is suddenly. It seems like the long-term structure of the financial system might have changed to support that price. When the mine was first being built out in 2024, when it was a mere twinkling in the Lundin's eye, the U.S. Treasury was still the bedrock safe asset of the global financial system. Now, since President Donald Trump has taken power in the U.S., people are starting to doubt that. They're starting to doubt that for the long term. So what other asset can be a bedrock safe asset? Well, the same one that's been there for millennia, gold.
Bloomberg's Ari Alstetter there. IA Financial is gearing up for a multi-billion-dollar acquisition push for more. We were joined by Bloomberg's Montreal bureau chief, Matthew Dion.
We met with the CEO, Denis Ricard, recently just to better understand where the company was going after this quite large acquisition they've made in 2025. They've acquired RF Capital for $600 million. That included Richardson Wealth. And he said that he doesn't want to do, well, maybe he will do some, but he wants to do a big acquisition now. He doesn't necessarily want to target tuck-in deals as they no longer move the needle enough. So he's thinking in multi-billion dollar terms here. The company has excess capital of $1.4 billion. They could raise some debt. They don't want to issue shares for now, but they could raise some debt. So it could be quite a sizable acquisition. On the top of his list is probably a U.S. life insurance business in the U.S. 15% of their sales are in the U.S. right now, 85% in Canada. They also have other segments. They are in individual insurance policies, car extended warranties, and wealth management. They have an AUA and an AUM of $241 billion as of the end of last year. So they are in several segments, but U.S. life will come first. It's on the top list for now. So he's being bullish as the company reached a record high market cap in January, near $17 billion. The stock price is down about 18% since, but still, he's still bullish and he wants his company to grow.
I'm not sure if you heard, I'm sure you did hear about that Citrini research piece with a scientific, or kind of a science fiction story set a few years in the future about what AI could do. And it's interesting, they claim that insurance renewables, where the entire renewal model depends on policy holder inertia, we just can't be bothered, was upended because the AI created agents who reshop for your coverage all the time. So what does he have to say about AI threats or opportunities?
Yeah, and the AI threat also disrupt wealth management firms right now, as the stock price for these firms are also down because of this AI disruption thesis, right? He still believes in the value of advice. He still believes in the value of customer relationship. And I'm going to read you a quote here. People don't wake up in the morning saying, oh, I'm going to buy life insurance, or oh, I'm going to prepare for retirement. You may know some people who do that, but they're weird people. So he's not saying that the AI threat does not exist. He thinks that AI is there to boost productivity, to better serve clients. The company, IA Financial Group, is investing $400 million per year in technology. They are invested in venture capital firms to understand emerging trends. But he really has this posture where he says, been there, done that. And if we think, for example, of Wealthsimple in Canada, the digital robot advisor, he's looking forward to see how profitable they are. And he said, I've been long enough in the industry to know that there are a lot of shiny new objects, and he referred to Wealthsimple as being a shiny new object. So that's his posture related to the digital risk.
Ouch. That's a bit scathing. Thank you very much. It is interesting, though, on insurance. Apparently, according to Citrini, people are just so passive about insurance, and that accounts for up to 20% of the premiums insurers earn. So I guess some people, the more tech-forward people, will have an agentic AI shop for things like insurance for them.
Yeah, but they could still buy insurance from IA Financial Group. So it's mainly insurance brokers that have been hit hard here by this report, from my understanding.
Bloomberg's Matthew Dion. Let's have a quick look at the market. Lots has changed in the last hour or so. The TSX coming back to 106 points up so far on the day, about a third of 1%. We're going to go south of the border and have a look there as well. Remember, Donald Trump made some remarks a short time ago to CBS in a phone interview about the conflict in the Middle East with Iran being over sooner rather than later. So that has moved markets up a little bit more on the day. The NASDAQ at this point up 1.3%. Coming up, the latest end of day numbers. We're back in just a moment. Stay tuned. Here are the closing bells for the end of the trading day. At the NASDAQ today, the Legal Aid Society ringing the bell. In New York, it's 1111 Media doing the honors. And for the TSX, Gemdale Gold celebrating the company's new listing on the TSX Venture Exchange. You're watching with host on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX started the day in the red, but has climbed back to a 105-point gain today, so up about a third of 1%. The S&P 500 gaining 0.8 of 1%. That's a 55-point move up. And the NASDAQ, a 308-point gain today, up about 1.4%. All right, having a look at oil, you can see a bit of a change right now. It's down under $90 to 87, so down $3.71 or 4.3%. Here's what happened. On the weekend, it was closing in on $120 US a barrel. And then a short time ago this afternoon, the American president, in a phone call interview with CBS, said the conflict in the Middle East is just about wrapped up. They're wrapping it up, he says. They're ahead of deadline. And so that has sent the oil price down, again, just in the last hour. Let's get to some of the movers in Toronto. Shares of Vizsla Silver down today, over 1%. The company dealing with fallout after 10 colleagues were kidnapped from a site in Mexico. Let's get to Kinaxis, supply chain software provider. They are up 6.2%. We're going to have more on this story from Stephanie Hughes in a moment, so the fuller picture straight ahead. Moving to First Quantum, it dropped today 1% or 39 cents as broader consumer sentiment weighed on performance. And moving to the U.S. pharmaceutical sector is moving today. Him and hers gaining today over 40%. That is correct, 40%, $6.42 move. We'll have an update out of the U.S. on this one in a moment. And then shares of Xenon Pharmaceuticals jumping today, also up 47%. The company reported strong late-stage trial results for its epilepsy treatment. Xenon said it plans to apply later this year for approval to bring the drug to the U.S. market. All right, let's dig deeper on movers in Toronto with Bloomberg's equities reporter Stephanie Hughes. Stephanie, Kinaxis, I know, is one you looked at, gaining today. Is this momentum from last week or something new?
It's a bit of both, Morella. So something new, something from last week. Kinaxis shares gained by over 6% at its highest point today, ending the day above that mark and still keeping up those gains. And that extended a 3-day rally for the company and put it among the top performers on the TSX today for pretty much the entire trading day today. So Kinaxis, a company that operates in the supply chain management space with planning and response management, they've actually boosted the amount of shares that would be involved in their share buyback plan, moving it up to 10% from their initial 5% earlier. So that's essentially doubling the amount of outstanding shares that would be involved. The share gains today are also building on the strength of that fourth quarter earnings report last week, where the earnings themselves came ahead of what analysts were expecting, and as did the 2026 revenue forecast. So it was a pretty strong showing there. So Kinaxis shares, just stepping back, we're under pressure in January and February, but the company is starting to stage something of a comeback. Not a massive one over the past few trading sessions, but it is bouncing off the bottom a bit there. The stock is also a far cry away from its all-time highs in 2020 and 2021 when the COVID-19 pandemic forced a lot of shutdowns and that really boosted the demand for supply chain software management. So the stock is still a matter of the stock moving in the right direction, and that's even after the CFO announced their departure last week. So in the face of that small team uncertainty there, we're still seeing some strong earnings and a good development for the company today, Morella.
Okay, let's get to silver core metals down today. What happened there?
Yeah, so it was precious metals just taking a beating in general. A lot of that was kind of unwound in the past hour. So easy come, easy go, I guess, or easy go, easy come back when it comes to the share gains. But for silver core, those shares were down by nearly 9% at their lowest point, which put it among the worst performers on the TSX for most of the trading day today. It's fell alongside other gold and silver companies on the index as precious metals prices gave way to a strengthening U.S. dollar. Now, the reason why there's that inverse relationship there is that a strong U.S. dollar typically reduces the demand for gold and silver. But it really it comes down to how long this conflict is expected to go on. So we got that news that it might be wrapping up sooner rather than later. So maybe that's why you're seeing more of the turnaround, Morella.
Yep, and I'm sure there's more to come in the fallout. Bloomberg Stephanie Hughes with the latest in Toronto. Thanks for that. Let's go to movers south of the border. We have Bloomberg senior equities reporter Bailey Lipschultz there. Bailey, a tentative agreement for Live Nation that would settle its court case. Investors seem to like it.
Yeah, investors really liking it. This is a stock that rallied to the highest level since September. The big takeaways are that at face value, a $200 million fee to be able to essentially keep the company intact is kind of just like a parking ticket of sorts. When you look at kind of the expectations going into this, there had been so much consternation around the lawsuit from the U.S. government pushing to break up the ability for Live Nation, which operates Ticketmaster, to operate venues and almost have a monopoly over selling those tickets in that venue. So the push, though it does seem like we're still in early talks around the ultimate resolution around this, is for the company to potentially divest up to 13 amphitheaters and also to create a bit of a more active marketplace on some of the venues that it does own. The big uncertainty going forward as it relates to this ruling is, what does the ultimate decision from the government and the ultimate settlement look like? Just because you have this partnership or the potential partnership for the company to say, all right, well, we'll let competitors sell their tickets on this platform for this share or for this venue. There's still a lot of uncertainty around what that ultimately looks like, but at the face value, the charges and kind of the settlement that we've been reporting from Bloomberg is a bit modest relative to what the street was penciling in.
All right, let's get to Hims and Hers, also up, but remind us what they do.
Yeah, this is a company that sells direct-to-consumer medications, drugs. So they do have some kind of partnerships with generic hair loss supplements or erectile dysfunction medication. They also, as we saw the stock rally today, coming off of their partnership with Novo Nordisk, can sell direct-to-consumer weight loss shots and weight loss pills. So in the U.S., if you're watching TV, you likely will see Hims and Hers advertisements about getting drugs like these GLP-1s. Well, the partnership with Novo gets rid of their long in the tooth feud that we've been seeing that was very, very public over the last few months. So the stock did rally after this partnership on optimism for what it could mean for the bottom line. Also seemed to be a bit of short covering. But when you look at that stock just on a 12-month basis, or if you even step back and look a bit further over the last few years, this is a company that is really a shell of its former self when there was so much excitement around GLP-1s and the ability to produce and sell copycat medications on their platform. So with this partnership, they'll be selling the real deal. But as you can see, this is a company that was trading essentially 3x what it is right now. So face value, a big rally in the Monday session for Hims and Hers, but still a lot of room to grow for the company to get back to where a number of investors likely paid.
Got it. All right, Bloomberg's Bailey Lipschitz, thank you so much for joining us. We'll talk to you soon. Up next, could small caps outperform large caps? Our next guest thinks that could happen. We're back in a moment. Returns from the Russell 2000 U.S. Small Cap Index have been flat so far, but my next guest believes they could outperform large caps this year. Let's go to Jill Carey-Hall, head of U.S. Small and Mid Cap Strategy at Bank of America Global Research. Thanks for joining us today.
Thanks for having me.
Why do you believe small caps could perform or outperform large ones?
Well, I think, this year we're expecting that for the U.S. equity market, returns are going to be more driven by earnings growth and multiple expansion. Within the large cap part of the market, we're expecting some rotation out of, big mega cap tech and growth stocks into the rest of the index. And then we do expect some rotation into domestic small and mid caps. They are expected to see better earnings growth this year. So if U.S. growth does hold up, and our economists here at BofA are expecting above consensus GDP growth this year, and we see earnings growth for small caps continue to recover out of the recent earnings recession. If they do see better earnings growth this year, that we think will drive out performance, and the recent recovery in the ISM manufacturing indicator, which is actually the most correlated macro indicator with small caps historically, is another positive supportive point for that earnings recovery.
Okay, so let's zero in a little bit and look at the last week now that the Middle East conflict has proven to go beyond the week. How have they fared during that time?
Yeah, so typically when you've seen geopolitical conflict historically, the Russell 2000 has sold off around 10%. So typically a little bit more than large caps. So typically you do see small caps tend to underperform during the sell-off on macro shocks or geopolitical events. Typically for both large and small caps, that sell-off tends to be recovered within 3 months. And obviously the question will be, how long this persists, and the shock in oil prices, if it is a temporary shock or something that lasts a long number of months with oil sustainably above $100 a barrel. I think if in the event that oil prices sustained, high oil prices were to raise risk of stagflation, which is not our base case. In those environments, equities tend to underperform a number of other asset classes within equities. The Russell 2000 has held up better than the S&P 500 in historical stagflationary periods. When you look within equities, typically value stocks have tended to outperform growth stocks. I think, what would be a consideration for small caps this time around is their sensitivity to the Fed. If inflation is persistently higher and that raises risks that the Fed stays on hold longer. So I think focusing on, areas of small caps that are less levered, less sensitive to rates in the Fed are where we would focus in that event.
Okay, the U.S. court decision on tariffs would have helped out small caps, but there's still a tariff. So I'm wondering how limited the relief has been for them.
Sure. I mean, I think, the tariff rates, the effective tariff rate prior to the recent decision on the IEEPA tariffs, is a bigger headwind to small cap profits because these stocks have much thinner margins. So higher input costs do cause a bigger hit to their earnings. And corporates have been relatively resilient. You've obviously seen some impact from tariffs, but companies have been able to, use pricing power and other avenues to mitigate some of that impact. Companies also had built up a lot of inventory prior to the tariffs going into effect. But now, now that the IEEPA tariffs, we've seen that ruling, we do expect that the overall effective tariff rate will be several percentage points lower, even with the introduction of the temporary tariffs. So on a relative basis, that's a relative positive for small caps. And we've seen since the beginning of the year that earnings expectations for small caps have been coming up rather than down, and guidance from corporates has been a lot less conservative than we typically see at the beginning of the year. So that's a positive sign that, I think should give investors more confidence in the small cap earnings recovery than a year ago when that can kept getting kicked down the road.
Okay, I don't want to look at the wider markets because you say stocks are down. Typically, it's time to buy on the dip, but right now that's limited. Why is that?
So when we think about the broader market and the S&P 500, we've been expecting that rotation out of some of the larger mega caps into the rest of the market that I mentioned. I think when we think about these geopolitical shocks and the typical sell-off as a dip buying opportunity, the one consideration today is that investor cash levels are lower. So institutional investor cash levels are at very, very low levels relative to history. Retail investor cash levels have come down in recent years based on our surveys. So there's less cash to buy the dip with, so that could limit upside for areas like mega cap tech, and potentially limit some of the upside for the overall cap weighted index. And for the S&P 500, we are more positive on the equal weighted index or your average stock than we are on the cap weighted index and mega caps.
Jill Carey, got to leave it there. Thank you for your time. Appreciate it.
Thank you.
Up next, the Iran war continues, but the American president says it could be over soon. So we'll take a look at the risk to global data networks, a surprising one, when we come back. Time for some hot picks. We focused on the auto sector today. We were joined by Tom Narayan, RBC Capital Markets. He says opportunities are emerging across the industry, from suppliers benefiting from automation to automakers navigating tariffs and strong demand at the high end.
I think it's a majority owned by U.S. investors. So they make airbags. And they are the dominant player in airbags. They have over 50% of the market.
Wow.
You don't have to worry about EVs or anything like that. Cars need airbags. Just a really cool mousetrap type company. We really think it's a special company.
That's interesting. I mean, I guess there's a moat, isn't there? There's huge safety regulations, et cetera. Hard to break into that market.
That's right. They have this strong moat. It's like the overall addressable market for airbags, surprisingly, isn't super big, but that creates an advantage, right? So if you're an automaker, you're not going to try to get into that business. You'll just leave it to Autoleave. And if you get the airbag wrong, I mean, it could be a disaster for you. So automakers are like, you know what, we'll just use these guys. We're not going to do this ourselves. And the number 2 guy that does airbags is way smaller. They're not as good. They're not as automated in terms of their production. They're actually trying to sell that business. So it's a really cool moat, like you said.
Your next idea, GM. Why do you think this is a promising one among the automakers?
Sure. I mean, automakers right now, it's a tough place to be. You're worried about the Chinese coming in, and even in China, there's competition. Europe is, there's a lot going on there. And so the cool thing with GM is it's really self-contained in China. That's not a big place for it to be. It is not in Europe at all. So you don't have to worry about the Chinese competition into Europe. And then in the US, it's like 60-70% of large SUVs. It's buying back a lot of stock. It has run quite a bit, but then the pullback now, thanks to the geopolitical situation, I think creates a unique opportunity.
I'm sorry, but they must be in Europe in some sense, just not in EVs. They're not in Europe?
No, they're not. They're not in Europe at all. GM pulled out of Europe. They used to be with, Opel and Vauxhall. They used to be a player there, but a couple of years ago, they pulled out completely, which probably been the wise decision thanks to all the competition happening there.
That's amazing. Because they had Opel for years, I think you mentioned. That was a great brand. And so they just abandoned the European market. And they couldn't even make SUVs or crossovers work in that market.
Right. Yeah, I think they saw the kind of what was going to happen in Europe with the competition there. Also, the CO2 rules are really stringent and strict there. So I think GM realized, let's stick to our core knitting, this like ICE large SUV in the U.S., which is protected, right? Like, I don't think the Chinese are going to come to the U.S. for a while. So I think they really saw the future and acted on it. And it looks like it was the smart decision.
And what are they doing now in electric cars? Can you remind us, or do they have a big investment program still in EVs in North America?
Sure. They were kind of later versus what like Ford did, for example, and that kind of helped them out. I think, Ford went aggressively with like the Lightning and the Mach-E, and there was a lot of competition. And now what we're seeing with all the policy shift in the U.S., that's hurting companies that really went aggressively EV. What GM did instead is do a flexible architecture. So on the same production line, they're making an ICE car, like a non-EV. They can also make an EV. And so what does that mean? Let's say EVs aren't in favor. They could just make more of the other types of cars. Whereas other companies, they have a plant that only makes EVs, and those are, facing some hard times. So they do make EVs, but they were kind of smart about it so they could pivot towards ICEs. You saw a lot of these impairment charges that the Detroit 3 took. GM by far was the smallest that they had to take because of how they engineered their manufacturing.
And so they have the Chevy Bolt with a B, and it's apparently rare. It's less than $30K in the U.S. market. Rare to get one below that price point.
Yeah, I mean, they also have the Equinox and the Blazer EVs, but they've really been deprioritizing that EV push right now for obvious reasons. And what they really want to do is really stick to their core knitting, right? Large SUVs, pickup trucks, the ICE business, and I think they're also going to benefit from the tariff change that probably is going to happen. They produce a lot in Mexico. So I do think a deal that the administration strikes there could be another advantage. And, if you're the administration right now, you probably want to strike a deal given everything that's been happening.
And then finally, something a bit racier, Ferrari. What's the attraction there?
Yeah, look, this stock has been, a monster success for years. And a lot of people, the biggest pushback we always get is, oh, wow, this thing is so expensive. And it has been, but it's pulled back a lot, right? Thanks to some of the geopolitical stuff going on. Also, they had an investor event in October last year where they tried to manage expectations lower. And the market really didn't like that. The stock really pulled back like 30%. So we think there's a cool buying opportunity here, a rare one. This stock rarely, pulls back a lot. It's just a great business. We all know what it is. I think that's a growth story. The ultra high net worth category is one that is growing. It's pretty economically resistant. What's happening at the lower end of the economy is really untouched for Ferrari, and they have a new car that's already selling today called the F80, which is a €3.5 million priced car. Super high profit margins. We think they're doing 800 of these over 3 years. When you run the math on that, it's hard to not like what you see. I think that the company is just trying to manage expectations. And like we've seen historically for this company, they always, to use an investor phrase, beat and raise, and I do think you're going to see more of that from Ferrari.
The F80. I guess if there was prolonged disruption in the Middle East, Ferrari and other deluxe car makers would feel some pain.
That is true. In the past, they did see there was oil shock in the Middle East. They did see a little pain on residual values, the secondary market, which does impact Ferrari. It's something we're definitely closely monitoring. I think the Middle East is about 10% of their car sales, though, so it's not the end of the world, but the residual values could trickle down overall. So something to monitor for sure. Hopefully, obviously, this is a short-lived geopolitical situation. If it's long-lived, then I think Ferrari would also be a company that would be impacted.
Tom Narayan there, lead equity analyst, global autos at RBC Capital Markets. Did you know that there are underwater cables in the Strait of Hormuz? So damage to them could affect key tech in the Middle East. Let's go to Chris McGuire on this, senior fellow for emerging technologies at the U.S. think tank Council on Foreign Relations. Thanks for joining us today.
Thanks a lot for having me.
How extensive is the underwater system? How vulnerable is it?
Yeah, so I think the risk of digital disruption in the Middle East is real, but it is pretty regional right now. You have data centers in the Middle East that are being struck, but the region is very dependent on submarine cables writ large that largely do run through the Strait of Hormuz. The data centers and cables are vulnerable, but they really are mostly serving the Gulf markets and not the global markets right now. Obviously, there are large-scale data center build-outs that are planned for the Middle East, and that would fundamentally change the picture if those were to go forward. Most of the submarine traffic that is serving the global markets runs through the Red Sea. And if you were to see a circumstance where both the Red Sea and the Strait of Hormuz cables were to be impacted simultaneously, you would see pretty catastrophic global disruption. That's probably not the most likely risk right now, but it's something that can't be ignored given the kind of extent of the conflicts.
Okay, so would it be drone attacks then that pose the biggest threat?
Yeah, I think that drone attacks on the data centers themselves are probably a more direct threat than the subsea attacks happening. But that said, I think that subsea attacks on the Strait of Hormuz can't be ignored. There is some redundancy there. There are some landing sites that are outside of the direct strait. So if those cables in the strait were to be cut, there might be ways to still funnel data both to the Gulf and to Iran. But the really interesting development here, too, is the physical attacks on the data centers themselves and the fact that these data centers are now clearly seen as military targets. Not only do you have two in the UAE that were struck, but also one in Kuwait. And the Iranian regime has actually specifically said that they are targeting these data centers as military targets, which is a new development that commercial telecommunications and AI and data infrastructure is now seen as military targets. So I think that is going to both significantly impact how the conflict goes forward, but also probably post-conflict, think about how investors are going to to evaluate the risk profile of kind of large-scale digital investments in the Middle East and elsewhere in any other geopolitically volatile regions, and really kind of drive demand for redundancy associated with any of those investments.
Yeah, we'll talk about the major investments some of those countries are making in that technology in a moment. I want to talk about the underwater cables for a moment. Have they ever been damaged before?
Not the Strait of Hormuz ones, but there was a significant incident in 2024 in the Red Sea where it was actually accidental damage, where it was the anchor from a damaged boat that moved across the cables and cut a number of them. That was a very significant incident. There's 17 submarine cables that transit the Red Sea. They carry the vast majority of all data between Europe and Asia. If all of those were to be cut, that is a critical vulnerability. And the most likely way that those would be cut, and I think this applies to in the Strait of Hormuz as well, is via an accident, not necessarily a direct kind of purposeful attack, although that's certainly possible and something we have to guard against, but just a damaged vessel that is dragging an anchor that can move through and cut the cables. So even if there's all the efforts in the world to protect the cables, these are still really critical choke points that are very hard to fully protect, especially given their kind of economic and strategic and technological value.
Let me ask you a technical question you may not know. How deeply are they buried?
I wouldn't profess to be that degree of an expert, but they're not necessarily easy to touch, but they're something that either a determined nation state can certainly touch. That there's a variety of countries that are developing the capability to actively target this infrastructure, but also just the fact that dragging anchors across the bottom of the ocean shows that many of these are just laid on the ocean floor, and there's significant vulnerabilities there. Like this is a hard thing to physically harden, and it's something that I think we need to have the ability to rapidly repair, and also just have global redundancy in network. That means increased terrestrial cable capacity, probably satellite backups, things that really aren't in place now, especially in the Middle East, where there is not an overland cable that connects the Gulf to either Europe or Asia, because that would have to go through Iraq or Iran or Syria, none of which are destinations people wanted to build through. The Saudis are trying to build a cable through either Israel or Syria now, but that's not complete. So I think having some kind of redundancy there that's overland is critical, but it doesn't exist right now.
Okay, I do want to get you quickly on the data centers. You mentioned some have been struck by drones, which we understand. I don't know how far along some of these countries in the Middle East are in their build out of data centers. We know they're investing a lot of money and that some North American companies are involved in the build out. How would you say they've been affected? Has there been what you would call a major setback at this point with the drones that have hit the data centers?
So the data centers that have been impacted have been mostly kind of commercial generic cloud data centers. There has been some impact on the ground. I know that AWS has advised companies to move away from the Middle East, move their services away from there, just to kind of hedge against risk. But it's not as if this entire infrastructure there is crumbling. The big question is just as the really big build outs are being built, and none of these are online yet, but the really big AI data centers that will contain tens of billions, maybe even hundreds of billions of dollars worth of AI chips. What is the geostrategic and geopolitical risk associated with having those there? I think the U.S. has thought many countries have thought for a long time about the risk of dependence on Middle Eastern oil, and obviously have developed very significant resiliency campaigns and broadly have tried to diversify away from that, but also kind of work with good partners in the Middle East who are producing that. But the question, I don't think we have as many plans on kind of Middle Eastern data centers or Middle Eastern AI. And if there are going to be large-scale data centers built out in the Middle East, and it is going to be a geopolitically volatile region like we see now, then we have to protect those more, both from physical attacks, cybersecurity attacks, or cyber attacks, and kind of the other litany of causes that could cause these to go offline, because this is becoming the most important and valuable infrastructure in the world, and we have to prioritize it accordingly.
Chris McGuire, good to have you. Thanks for joining us today.
Thanks a lot.
Gold prices down today, even though the Middle East conflict has carried on and increased global instability. We will look at the factors behind the move down when we come back. Here are the stories we're following today. The American president now says he believes the Iran war is, quote, very complete. That's coming from CBS. Donald Trump added Iran's missiles are down and that the country has no Navy, Air Force, or communications, saying the U.S. military is far ahead of its original estimate as far as timeline goes. The comments come after Iran announced a new supreme leader on the weekend. Shares of Hims & Hers soaring today after the U.S. drug maker struck a deal with Novo Nordisk to start selling obesity drugs. The partnership comes as somewhat of a surprise after Novo sued Hims in February for launching a copycat version of its new Wegovy weight loss pill, a linchpin of its growth strategy. The Danish drug maker accused Hims of breaching the U.S. patent of the ingredient behind the best-selling medications Ozempic and Wegovy. Shares of Live Nation up today as the entertainment company reaches a settlement with top U.S. policy and politics federal antitrust authorities in a lawsuit that had accused the company of illegally monopolizing the music industry. The agreement requires the concert giant to pay about $200 million in damages, but the settlement agreement will still need to be approved by a judge. A quick look at the markets, which turned around later in the day. The TSX Composite up 105 points by end of day, 0.3%. The S&P 500 ending the day up 0.8%, and the Nasdaq gaining 1.4% today, or 308 points. Having a look at West Texas Intermediate right now, which has been whipsawing over the last day. It was up to $120 US a barrel or so on the weekend. Today, at this hour, down to $83.85. So it's a 7.7% drop, or about $7 and change. Again, on comments from the American president that the Iran conflict could end sooner than later. Our next guest says we are in the golden age of fixed income, but as a conflict in the Middle East raises inflation fears and investors look outside of government debt markets for safe haven value, is that window of opportunity getting smaller? Let's go to Rick Reeder, CIO of Global Fixed Income at BlackRock. Rick, thanks for joining us today.
Thanks for having me on. I appreciate it.
There's so much going on, but what does that window look like right now?
So, well, you say so much going on, the volatility every day, the news flow every day. I was thinking, I woke up last night in the middle of the night watching these markets moving around, and then I kept waking up, and you realize we're going to live in this period of volatility, of uncertainty, what have you. I think that window is still there around getting yield. I mean, by the way, you look at today, I mean, look at where 10-year treasuries are in the U.S., and they haven't really moved over the last couple of years, with some variability. We keep coming back to around the same place. The window of opportunity is around where you create income, and that income, whether it's using things like the credit markets, the real estate market, the mortgage markets, et cetera. So I think there's, as long as you believe, which I do, that inflation over the intermediate term is 2.5 to 3 and maybe coming lower than that, I think it's a great time to get yield and income in the portfolio. I just think you have to be balanced in how you get it, and you have, quite frankly, oftentimes you got to extend the lens a bit and say, I can't watch every day because the volatility's high, but income will do its job.
Okay, you heard the American president now saying the conflict is pretty much over, close to being over. Does that alleviate any overarching concerns about inflation?
It's helpful. It's helpful to the extent that it's hard interpreting what that means and how to think through what is the T+1. Listen, if today, where oil prices, the spiky nature of it, like you saw last night, is something that the market's going to have some concern around for interest rates, for fixed income generally. To the extent that we are on the backside of that volatility, yeah, that would be a comforting thing to witness.
Okay, let's talk about fixed income outside of North America. Where are you looking these days?
So, I mean, one of the great, we've had this period of time where the dollar has been restrained, other than this period where the dollar rallied. I actually like emerging market debt. You've got to be a little bit careful around today. We've reduced some of the exposure a little bit, but you look at today, the income we get in places around the world in emerging markets. So parts of Asia, parts of, quite frankly, Latin America, places like Mexico and Brazil, where the yields are extremely high. Again, we got to be careful in the near term around currency, but looking for getting your yield into the portfolio in the emerging markets is a place we like quite a bit. Owning credit in places like Europe has been fantastic for a couple of years. Today, the spreads have gotten a little bit tighter, but we still like things like the securitization market in Europe and including places like Australia. So we're looking for like where we can go in the securitization market around the world, getting more developed in places like Europe and Australia. And so those are opportunities we're looking at.
Okay, so in emerging markets, is there one that you like over others? And would you jump in now, or is it something you're just watching?
So I like Mexico. I mean, I like front end yields in Mexico. I think ultimately inflation will come down. It's certainly more stable and from a political point of view than many of the places we look at. And not only on the government debt, you can also buy corporate debt in Mexico. So I like Mexico. That being said, being a little bit patient today, given the volatility in terms of how you increase your exposure. But listen, I will say one thing for investing for a long time. We're going to go through these periods where you get these bumps in a round of volatility. I think like everything we do, and same thing with equities, is you buy a bit today, you see where we are, and you're patient, and you add to it on more pressure over the coming weeks if you get it.
Where are you landing these days on a rate cut in the U.S.? How much of it depends on the length of the conflict in the Middle East?
So, I mean, I think the Fed's going to cut this year. I think they're going to try and cut a couple of times. I think clearly when you've got higher inflation prospects, do they sit on hold for a longer period of time? I think you have to respect that. And I think the markets have priced that. That being said, I mean, it's very important when you think about what causes inflation. When you have a demand-driven level of inflation, that's very different for the Fed than it is when you have a supply shock. Because what a supply shock does is it actually transmits a slower growth paradigm. It definitely brings down consumption. It brings down growth. I still think it leaves the window open for the Fed to cut. I just think you extend out a bit longer because people will look at that inflation to see how much is supply versus demand driven. But gosh, if there was a supply shock like this is, then I think you can still cut. In fact, I think you should cut because of the pressure it puts on, particularly lower income, small businesses, that I think actually enforces that you should cut. Do they wait a bit longer? Yes, I think so.
Okay, so factor in, and again, this goes to the whipsaw nature of what we've been seeing. Factor in the jobs numbers, right? 92,000 lost. That was unexpected for the most part. Factor that in to what you're thinking for the central bank.
So, I mean, there are certain things that are, in markets that are ambiguous. Your question about what does it mean in terms of the conflict and how close are we, those things are very hard. And as much AI and other tools that you have to figure it out, they're hard. Figuring out that we have a decline in employment is not that hard to figure out. When you strip out healthcare jobs, we've had for the last 9 months negative 358,000 jobs with an economy that's running over 5% growth. That is not ambiguous. We have a job problem that I think longer term, we think this is pre-AI, most of what's coming in AI, pre-robotics, pre-automation, or the real impact of those dynamics. So I think, and part of why I think the calculus of rate cuts should be there, is we have, with an economy that's really doing well, we're not hiring people away from healthcare. Healthcare is demographic driven. We have an aging population. It's not cyclical, but I think it's quite real that we're just not employing enough people. And I think moving rates, being helpful from a rate perspective, that's a big one. It's different in the ECB when their sole mandate is inflation. When your mandate is maximum employment and price stability, that employment dynamic, we're certainly not anywhere close to maximum employment when we have that sort of job loss.
Rick Reeder, I got to leave it there, sir. I'm out of time. Appreciate your time. Thank you so much for joining us.
Thanks for having me. Thank you.
All right, we're going to take a quick break. Back in a moment. BlackRock hit the brakes on redemptions in its $26 billion HP corporate lending fund after withdrawal requests surged past 5%. Let's go to Bloomberg's private credit reporter, Olivia Fishlow. She joins us now. Olivia, first of all, what is spiking the request for redemptions? Is there anxiety there?
Definitely, yeah. So I think there's a few things that we're hearing that are spiking the redemptions in private credit. One thing is just lower rates are bringing down the expected returns of the asset class. But we've also seen in recent months sort of a fear around credit quality, and especially the amount that these private credit lenders have gone really heavily into software, which, as you know, is now being upended by artificial intelligence and sort of like fears around what the sector will look like. All of these different fears are sort of coalescing together at this moment and creating widespread redemptions across the industry.
Okay, so the 5%, I guess it's a quarterly limit on withdrawals. How flexible does that tend to be?
Definitely, yeah. So for these vehicles, these non-traded BDCs, they are not required to give any money back. So this is something that they decide to do. And in their documents, they can give 2% above 5%, so 7%. And then if requests go above that, they actually have to amend their fund if they plan to give money back. So sometimes, as you can see, they chose to not amend their fund, and then they chose to not give the money back. So they can be flexible, but there's definitely some documentation that goes into that.
Okay, so what happens now if BlackRock is basically saying to investors, we're at a max for a quarter? What happened? Are these investors just turned down then?
Yeah, so for this quarter, the ones that got out were able to get out, and the ones that didn't, their requests were sort of like null and void. And then what BlackRock is saying is next tender offer period, these investors, if they want to, can like put in requests again. But once again, if requests exceed 5%, it's pretty clear. I think they've indicated that, in this case, they didn't accept beyond 5, and so I think it's a fair assumption that they probably wouldn't accept above 5 in the future as well. So it can be sort of an extended period of just investors waiting to get their money back, but they're unable to for a long period of time.
And because BlackRock has done this now, essentially that opens the doors for other funds to do the same.
Yeah, definitely. So it's sort of a question of, if you're seeing these elevated redemptions, do you cap the fund and stop investors from fleeing because that gives you more money to focus on new investments. It allows you to exist as a fund. Or do you give everyone their money back, which can have its own downsides? And I think people were maybe afraid of the consequences of capping the fund. But now that a big industry player like BlackRock has done it, I definitely think that we could see other funds follow suit.
So how popular are these funds? Have they gained in popularity more recently?
Yes, so these funds have become a very popular way for retail and other investors to access the asset class. And because, they have like similar funds that trade publicly, these funds can appear sort of like these exclusive type of funds that they're pretty easy to access. And then they market themselves as like semi-liquid vehicles, and you can access private credit. So we've definitely seen more and more investors pile into this asset class, and the assets under management grow and grow. And now this is the first time we're seeing investors start to change how they're feeling and actually want out of these vehicles.
Speak to me a little bit more about what drives investors there. Is it just access to a more exclusive market, even though, as you mentioned, it's not necessarily that liquid?
Yes, definitely. And I think it's also been the yield associated with private credit, right? These generated pretty high returns, and also as companies stay private for longer and longer and are accessing private credit in order to be financed, it's sort of an exclusive sleeve of investments that maybe these investors couldn't find elsewhere. So I think there was definitely a lot of interest around these companies, and even like the software companies that I mentioned, right? These where it's hard to access them in the public markets, and these things that were once a draw maybe now are becoming even a negative factor.
All right, Bloomberg's private credit reporter Olivia Fishlow joining us today. Olivia, thank you. Appreciate that update. Here's how we ended the day today on Bay Street and Wall Street. Started off in the red early on, but then a turnaround later in the afternoon. 105-point move up on the TSX, 1/3%. The S&P 500, 0.8 of 1% up. That's a 55-point move up. The Nasdaq, a gainer of 1.4% today, or a 308-point move. Quick look at where oil stands. It was up close to $120 a barrel U.S. on the weekend with everything happening in the Middle East. It lost some of that strength today. It's down 7%, $6.36 drop. And Know Your Options is back on Wednesday. Send in your questions for that. And thanks for joining us today on The Close. We'll see you back here tomorrow.